With world-class expertise and local insight, Dexus creates value, not just for today, but long into tomorrow.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Well, hello, and welcome to the COB on Monday, May the 5th. I'm Nadine Blaney, and what a day this has turned out to be. So we had expected to see a bit of a rise at the open of trade here in Sydney, but a couple of things happened. We saw US futures really take a turn. We saw the oil price fall out of bed after we saw OPEC Plus agreeing to increase production. So now there are concerns of a surplus. We've had the oil price below 60 US per barrel. And we've also had the start of the bank's reporting season. So the big four banks and Macquarie, ex-CBA, do report results in the coming trading days. And Westpac's, if that's anything to go by, it was a little bit lackluster, if we're being honest, and if we take the share price reaction as our guide. So plenty to discuss as we move through this COB show and podcast. Really great to have you along with us to start this brand new trading week. So it's all about Albo 2.0. I've been doing a lot of reading today, a lot of talking as well about what's to come next, and speaking with our expert guests, saying that now it's really important. This was a conversation that I had with the Kook a little bit earlier today, saying really important that we get policy put in place that will help stoke those so-called animal spirits, getting businesses to invest, getting businesses to spend in this country. But look, the economic policies he doesn't see as being any hindrance to the RBA cutting rates, at least in May. You can find that interview up online at ausbiz.com.au. I also spoke with Magenta Advisory. Grant Lovett joined us on Friday for the last call, so it was really great to catch up with the team there to find out, what they made of what was a very surprising election outcome. Although we had expected Anthony Albanese to put in a strong showing, as you well know, not as strong as we had seen. We are also, again, keeping our eye on oil, really tanking, and the banks. A bit of a bust today as so far as the banks were going. But look, as far as a weight on this market overall, look no further than the energy sector. It had a terrible session. So helping to snap this winning streak that we have been on, energy was off by close to 3% as a whole. We've got the banks, so the financial sector, also proving a big weight on this market. As a whole, the bank's down, I should say the broader financial sector is off by about 1.5%. But look at Westpac there. So clearly underperforming, down by 3%. And if we look at healthcare, I thought I should put something on here that's looking a little more positive. Even Sonic, it was touted as one of those companies that does stand to benefit under the new government, down by 0.1%. But CSL looking good, and Ramsay Health up by 2.25%. You could probably put some of that down to this new Labour government and its intentions for spending on health. So some other corporate stories, if we take a look at some of the performers, we've got Qantas up by 1.5%. So it wasn't the biggest percentage point gain, but think about it. If the oil price stays low, if we've got the surplus that's also being brought about by slowing global growth, don't forget we still do have tariffs bubbling away in the background. We heard from the US President Donald Trump today saying he was going to put 100% tariffs on films, foreign films coming into the United States, because apparently he says Hollywood is dying a fast death because of what other countries are doing to help support their own film industry, which I think is pretty amazing when you consider the dominance of US culture right around the world. Also very interesting considering they're in a trade negotiations with India, which of course has a very healthy film industry. Anyhow, we had Dan Murphy's owner, Endeavour, reversing year-to-date losses. Said they had a good selling period in Easter. They're expecting things to continue to pick up. Excuse me, Reliance Worldwide, it's put some color around the impact of U.S. tariffs. So it's downgraded its earnings outlook, shares down by 2%. And Goldfields has agreed to acquire 100% of Gold Road, and that sent its share price soaring. Further M&A on this Monday, Tyro withdrawing its bid for SmartPay. SmartPay has a competing international offer, so knowing when to fold them, I suppose, Tyro's being rewarded for today. And Helios hit a near 6-month high on a special divvy being paid. And Playside Studios is at a record low. Its co-founder has resigned. Also, I believe he was head of creative, so taking a big toll on the share price there, off by 18%. I'd like to welcome to the COB for the first time, I think, Rick Squire, who's joining us from Acorn Capital. Rick, a pleasure to have you here. Look, when you look at the day's trade, in the broader context of tariffs and China and a new government here, what do you make of it?
Yeah, it's certainly the disruptions continue, but that's sort of feeding into the volatility that gold loves, and that's where the safe haven is. But we're now starting to see a few opportunities pop up in some of the commodities. So you've got to be careful not to be too early on these things. That when you're 3 or 4 years early, you're not actually early, you're wrong. So there can be a trap of trying to get too early on a deep value. But there's certainly a couple of commodities that have come off the bottom and are showing some life, and there's some good opportunities out there.
Well, I mean, let's just discuss one that you can't look past, and that is uranium. I mean, we've seen Paladin Energy, for example, just absolutely bounce really well. Really, since Easter, they've been quite strong. So what do you put that down to? Is it something fundamental, or is it, again, this extreme volatility that we seem to get around uranium?
Yeah, there's a combination of factors that played into the recovery of Paladin in the last couple of months. That there was a lot of euphoria in the market in early 24 or the first half of 24 when uranium prices ran quite strongly, and the Paladin share price really responded to that. And because it was the biggest uranium stock on the ASX, it went into the ASX 100. So a lot of those index funds loved it as a cross from the 200 to the 100. There was really strong buying, and then there was an unwinding of that buying when the spot price for uranium fell. But the really interesting thing that happened in the market is that the term price, the long-term prices that uranium companies lock into when they approach a utility and they sell their uranium over the next few years, that term price was actually stable, and it hung around roughly $80 a pound US for the uranium. Yet the market became very negative, and because Paladin technically went outside of the top 100, it was still in the ASX 100, but there was a risk that it could actually get tossed out of the index, the S&P ASX 100, and so that led a lot of shorts to get into the stock. So it became a very heavily, I think it was the second most shorted stock on the ASX. So there were the fundamentals there, and then on the back of this, they were starting up their operation. They had a lack of rain, which actually curtailed their operation early in the year. Then suddenly the rain did come, and it was too much rain. So they had some bad luck there. And then the usual commissioning issues. They had problems just on the initial startup. But in April, they put out a really good announcement that it looked like they were getting on some of the technical challenges that they've had over the last 6 months. So operationally, they were certainly starting to turn the corner. So with that, I think there's been an unwinding of some of those shorts, and that's why we're seeing a combination of factors that are driving that really good performance.
Yeah, Rick. So do you there at Acorn have exposure to uranium stocks?
Yeah, we do. We have a little bit of Paladin. A preferred stock at the moment is probably Boss Energy. That's actually the most shorted stock on the ASX. But again, it's going through startup. It's got plenty of cash. It has uranium inventory. There's no threat of a raise or need for a raise, certainly anytime soon. So that's probably our preferred stock in the sector. Although when we saw Paladin at the levels that it got to, it was really deep value, and so we picked some of that up, and that's why I quite like the stock. I think there's still more to go in terms of the run that we'll probably see. Likelihood of the shorts continuing to be unwound as not only as they try to get out, but as the long only funds see a great opportunity and are getting in. So, fighting for that stock at the same time.
Yeah, all right. Look, Linus was an outperformer today, up by 2.3%. Why is that? Is that, the new Labour government promising to have some sort of critical minerals strategic reserve, even though Amanda Lacaze, the CEO of Linus, came out quite forcibly saying that could even be bad for their business? Or do you put this down to, Donald Trump, the possibility that, Australian rare earths could be in demand in other parts of the globe? How do we read this?
Yeah, it's a great question, and it is a difficult one to read. What all the talk about, these critical mineral reserves, agreements to mine critical minerals in Ukraine, all these sorts of things, that it's really highlighting the importance of rare earths. So as the listeners probably know, that rare earths are the key component of the high strength magnets that are used. They're used in wind turbines and electric vehicles, but really strong future outlook is in robotics, because what you need is a really strong magnet, but you need it in a small space, so it needs to be very condensed, but strong. And so there's different rare earths and different mixes, and that nuance in the difference is really important, and Linus is recognising that, and traditionally they've produced a lot of the rare earth elements known as dysprosium and neodymium and praseodymium. But the really high strength magnets also need dysprosium and terbium, so they need all four. And the dysprosium terbium only occur in certain types of deposits, and they're not as common as the neodymium and praseodymium. And so it's companies like Linus, and there are governments like the US governments and a lot of companies are starting to recognise the importance of these subtle differences in the compositional mix of those rare earth deposits, and where they can get their source, where they get their material from. And so all this talk about Ukraine sources and all this, to me it's just really highlighting you've got to be looking for the companies that have the right mix, but really importantly that can get in production quickly and can do that with modest technical risk. So Linus certainly has a big advantage in that they're already in production. They're heading down the path of developing a plant in the US that will produce some of these more unusual rare earth elements, and so they've got an opportunity. But there are a couple of other companies in the mix that can really take advantage of that too.
Yeah, fascinating area of the market, and then China's influence, of course, as well. Just before I have to let you go, it's a pleasure to speak with you on the COB today. Are there any other sort of unloved commodities that you reckon are due for a bit of a re-rating?
Yeah, I think one of them would be domestic gas. That in Australia, anyone that's paying a gas bill at the moment would know that the price of gas is really high. We've had a couple of tough years, but there's a couple of very large drilling programs going on in Bass Strait over the next 18 months or so. And if you look back a few years pre-COVID now, but look back to some of the more buoyant times, it was when they were drilling those wells, because it's very expensive to get these big rigs into Bass Strait to do that drilling. But if you make some discovery and you can convert that in a reasonable time frame into production, I think you're going to see some re-rates. So for that reason, really like what Amplitude is doing. Amplitude Energy, it's the old Cooper Energy, that they're drilling a couple of wells. They're now funded to do that program. This time of year, it's that shoulder season between the really hot summer months and the really cold winter months that gas production is typically not the highest part, and so you're seeing a little bit of selling off just in that interim shoulder season. But as we head into winter, the threats of gas shortages lead to higher prices. Compounding that is the potential for discovery. I think that's an area that that's a part of the market that could be quite exciting over the next probably 12 to 18 months, and it's something that we like rather than a longer one. The other one that's probably under the radar, we've seen that there's a pullback in oil prices today. It's hard to get excited about oil, but I think coking coal is a little bit different just in terms of the supply dynamics. That it's more challenging to get the material. There's still strong demand for it in India, while there's softening in the construction in China. That consumption of quality coking coal for steel consumption. We think that the market's probably overreacted on the downside there, and a bit like buying Paladin and Boss a month or two ago, that you could be seeing quite deep value in coking coal, but just be a little bit more cautious around the coking coal play, whereas I'm a lot more confident about the opportunities in the domestic gas in Australia.
Right. Well, Rick, thank you. You've given us lots to think about today and dropped some company names as well. I hope you have a good evening. It looks like a nice one there in Melbourne.
Great. Thanks for having me on again.
Take care. Okay, so one of the corporate stories that we sort of glossed over a little bit earlier, of course, was Westpac. It did have its first half profit result out, and it did drop higher costs, some spending on technology, as well as hiring some other bankers in a competitive environment. Although the CEO did say perhaps we're at the bottom of the cycle, and the only way is up, with impairments as well as bad loans falling. So, stock of the day on the call today was Westpac, and Mathan Samsundaram from Deep Data Analytics and Kai Chen from MPC Markets weighed in.
I'm not surprised. The results weren't great. Market loves CBA. The rest are pretty much the same. In theory, all of them are fighting for the same pie, which is shrinking. You've got RBA that's cut rates with very dubious data, and they've already flagged about 3 weeks ago that they're going to cut in May, despite no real data to back it up. And they've already flagged it, so it's in the data and it's coming, and the market knows it.
Westpac, really, it's just one of the staple commercial banks. It's good. I mean, look, what did flag it in this reporting was basically their CET1 ratio. It fell about 31 bips. It's still well above, what APRA demands that the banks hold for their CET1 ratio, above 10.5%. So there's nothing really worrying about it. But yeah, I guess to summarise, it's just a bit lacklustre in terms of performance.
So holding it though, or not?
If you have it, mainly for capital gain. I mean, a lot of people would have bought it very early on, accumulated a fair decent amount of capital gain.
So there you go. That was Westpac. Let's see what led the market higher today. This is, of course, as percentage terms. Gold Road on that takeover up by 9.9% block, recovering from Friday's steep losses at $71.02 to end. Generation Development Group, that was battered last week around this time, up by 4.5%. Helios and Lifestyle Communities on the leaderboard. The laggards, though, SiteMinder smashed. I didn't see any news associated with it, nor Nuix, but both down significantly, as was Clarity Pharmaceuticals, Helia Group, and Stanmore Resources in the coal space. Just had a good chat with Rick Squires from Acorn Capital about coal. All right, in the small to medium cap space, there's SmartPay after it's got an international offer on the table at, I think, $1.20. And you've seen some of the uranium plays there as well. Elevate Uranium up by close to 13%, 31 cents per share. On the other side of the equation, Antares Technologies off by 12%, and Alligator Energy also in uranium down by 7.8%. So worthwhile keeping your eye on those companies tomorrow to see if we get any snap back. Tonight we do have the S&P Global Services Index for April. Of course, this comes in the US off that jobs report that we got on Friday. So not seeing a lot of the pain yet in the hard data, but we are seeing some of it reflected in the soft data. So we'll see, we'll see what this brings about tonight. It's expected to decrease. We also get earnings, Ford and Planter Technologies as well. So earnings quarterly continue in the US. Here tomorrow, we do get building approvals. It is a volatile read, but we're expecting to see council approvals to fall by about 1.5%. Speaking of falls, this market's snapping a 7-day losing streak, and those are pretty punchy losses, I've got to say. We've got, U.S. futures still in negative territory, even after a strong session on Friday. Look, what else can I say? It was not a great day for the banks, not a great day for the energy names either, with the oil price coming under a lot of pressure down below that 60 US level as well. The financials, telcos, infotech, A-REITs, materials, consumer staples, and consumer discretionary, all well into negative territory. So look, we'll see what this evening holds in the United States, and we'll bring you across everything you need to know when we are live once again, 9:45 tomorrow morning. Have a great evening.